Hello traders, Gary Wagner here. It is currently 10:30 in Honolulu, Hawaii. It is Monday, the 29th day of August, and this is the daily report for gold. Traders, we currently have the market down about $41, 1787. As you can see, current print on the board, and we are immersed deeply within a corrective period, which is following probably one of the greatest rallies ever witnessed in any market, but certainly in the gold market. And just to kind of bring us all up to date, you know, on my Elliott wave count, we were looking at this last leg, and this, of course, is our leg 5 in an intermediate count, but also 5, the way I have my count, in my major count, which means that we could, in fact, witness a more extended correction than we typically would if we were simply at a 5 count, but we were, for example, at 3 or at 1. Now, the market came down, and because we have a conclusion of A, just as we use our wave 1, in essence, as our benchmark to forecast waves 3 and 5, we also do this with our A wave. In other words, we will use A as a benchmark to kind of give us an indication or some potential for what we might witness with subsequent waves B and C. We will also, on today's report, talk about the type of extension we might get in this correction, which might not be an ABC, but it might actually be a 1, 2, 3, 4, 5, in other words, a 5 count. We'll talk about that towards the end of the show, but here's what we're looking at. Once we have this in play, one of the standard forecasting rules is that our next wave, that's going to be the impulse wave, or B, which is a counter trend wave. I say counter because we're in a corrective stage now. We take B, and it's going to typically go anywhere between 50 to 75% of the move that we saw in A. Now, traders, take a look at this. This then becomes our absolute range where we have a higher probability. Doesn't mean that's what's going to happen, but we have a higher probability that somewhere between 1806 and 1860 or 1859, we should see a conclusion to this particular wave. Now, if it's a complex wave, meaning if there's a structure within this wave, we might in fact get a 1, 2, and then back to 3, back up to this area. If we do not, what we have seen is that really we've gone pretty much midway between 50 and 75%. If I had to, it's probably sitting at around 60, 62%. And at least on a tentative basis, it appears as though we have concluded this B wave, and we are now in some sort of a C wave. Now, I talked about the fact that on a C wave, we can typically get a few different kinds of variations, but in essence, what you're looking at is follows. If the market trades and does not go to the bottom of A, it's a truncated C. If the market goes in and trades to this low would be 1695 to 1700. That's the low that we hit in A. It's called a flat correction. And then a normal correction, on a normal correction, your C would have to exceed your A and be below that. Now, given the fact that we certainly can see that after hitting the top here, which was roughly 1910, 1913, we came very, very close to the targets that we were looking at. Now, I had believed upper level projection somewhere around 1880. I had one at 1903, but that was a very soft target. I felt comfortable about the 1880. There's no doubt we achieved that. We went past that. The profit taking that came in, as we talked about on Friday, when we take a look at this entire rally, what I'm going to start calling our July 4th rally, because it began on the 5th of July after the holiday weekend. This market gave back roughly 50% of that move in a period of days. So, whereas on a typical correction following a major fifth and an intermediate fifth, I would look for a more sustained count, a longer count, the fact that we got this move so quickly told me that we might in fact see a fairly quick correction, but I don't believe it's over, and I do believe that we'll see some sort of an extension. B followed in suit. 50%, that's a logical point to look for. Market then moves up roughly between the 50 and 75% area. Again, falls within all given parameters. So, that being said, what is a logical point to look for the conclusion of C? And one of the things that we'll want to do, of course, is first use our benchmark. Our benchmark is now A. And what I'm simply going to do is take A and extend it from the top of B, and it will give me what I believe to be a set of parameters for the most, not the most logical, but the lowest point I think that this market could go to. And that would be, in essence, a 61% retracement of the entire move. I'll show you a point where we saw that once before, so it's not out of the question, but my target in terms of the downside potential is going to be breaking through not only 1700, which we just broke through, but actually breaking through 1600 as a distinct possibility. And thereby, this would be the lower end of what I'm looking at. The other logical place to look is going to be at what's called a flat correction, which would simply take us to about 1700 per ounce. So these are the two targets that I believe are possible. Don't believe that this will necessarily come immediately, but realize that there's real potential if this correction continues in the same way that it has. This has been Gary Wagner wishing you, as always, good trading, and we'll talk to you tomorrow for another daily update and review. Bye-bye.
And when I look in my window, so many different people to be.